Welcome to vpod.ai. Today we're going straight to the heart of things, focusing on, well, the company everyone's talking about, Nvidia.
Hard to avoid them, isn't it?
Exactly. Our aim here is to really get past the hype. We want to take a proper look at their financial fundamentals, their competitive position, using real data from 2021 up to 2024.
Yeah, see if the numbers actually stack up against this incredible valuation.
We need to figure out if this momentum is built on rock-solid foundations.
It's definitely necessary. I mean, when a company gets this big, sentiment can drift pretty far from the underlying reality. We're hoping to give you a clearer picture of what's supporting this valuation.
Okay, but before we dive into all those numbers, just a quick word from our sponsor.
Right.
This program is sponsored by Stonefly. They're leaders in enterprise storage, backup and disaster recovery, AI storage, and cloud solutions. If you're looking for secure, ransomware-proof storage, Stonefly sells air-gapped and immutable storage solutions.
It's really important these days.
Absolutely. You can contact sales at stonefly.com to schedule a demo. All right, let's kick off with that absolutely massive headline. October 29th, 2025, Nvidia becomes the first publicly traded company ever to hit a $5 trillion market cap.
$5 trillion.
Yeah.
It's a number that almost doesn't compute, does it?
Right. How do you even put that in context?
Well, think about it this way. That's nearly the same market cap as Google and Meta combined.
Wow.
And maybe even more staggering, it's more than the total value of every single company listed on the UK stock market.
So it's basically like its own national economy at this point.
Pretty much, yeah. It operates on that kind of scale now.
And the engine behind all this, the core reason, is clearly AI. Their GPUs, the graphics processing units.
Mm-hmm. They're essential. They're the computational backbone for, well, everything. Generative AI, large language models, cloud infrastructure, you name it.
And the data center business really shows that story, doesn't it?
Oh, absolutely. You look at 2023, the income growth in just that segment surged over 200% year on year.
200%.
Yeah, that's not just growth, that's explosive. It tells you exactly where the big enterprise money is flowing. It's all going into AI compute.
And what's fascinating is this isn't just based on hope, right? They have actual orders backing this up.
That's a key point. They've got visibility, basically confirmed orders, for around $500 billion.
Yes.
$500 billion in revenue through the end of next year.
$500 billion.
Driven mostly by the demand for the current Blackwell chips and the next-gen Rubin ones coming up. So that business is largely locked in.
That must provide a lot of comfort to the market.
Huge comfort. And then you add in some geopolitical factors, which seem to be helping sentiment, too.
You mean the talk about China?
Yeah, specifically President Trump mentioning potential talks with Xi Jinping about maybe easing up on the export restrictions for those Blackwell AI chips.
Oh.
If those restrictions were eased, that opens up an absolutely massive market in China that's currently, mostly off limits. The potential there is enormous.
So the narrative is incredible. Historic value, essential tech, guaranteed sales, maybe even opening up China. But we promise to look under the hood.
Right, the financial health check. Time to see if the engine's running as smoothly as the share price suggests, using the data from 21 to 24.
Okay, how do we approach this?
We basically look at 4 key areas using their financial statements. Liquidity, can they pay their short-term bills? Solvency, what about long-term debt? Profitability, are they actually making good margins? And finally, cash flow, is cash actually coming in the door?
Got it. Let's start with growth. Asset growth has been just wild.
It really has. Total assets jumped almost 70% just between 2023 and 2024. Went from about $66 billion up to over $111 billion.
And what's driving that huge jump?
Okay, here's a crucial detail. A big chunk of that was driven by a 130% rise in accounts receivable.
Accounts receivable, so money owed to Nvidia by its customers.
Exactly. It reflects that massive demand, especially from the big data center clients, AWS, Google Cloud, Microsoft Azure. They've ordered and received the chips, and Nvidia is waiting for the payment. That's the AR.
Wait a minute. If asset growth is so heavily driven by a 130% jump in money owed to them, isn't that a bit risky? What if a huge customer delays payment or something?
That's a really sharp point. It definitely speaks to concentration risk. When you have such massive deals with just a few giant customers, yeah, there's always a risk.
Okay.
But, context is important here. This is pretty typical for huge semiconductor deals. And these aren't just any customers. They're the biggest, most reliable cloud companies in the world. Still, you're right to flag it. Managing that AR growth carefully is vital.
Okay, but interestingly, while assets soared, their liabilities, their debts, grew much slower. only about 41%.
And that, I think, is probably the most positive signal in the whole balance sheet.
How so?
It means they're funding this incredible expansion mostly through their own profits retained earnings, not by taking on loads of new debt.
Ah, I see.
Yeah, look at the ratio. Total liabilities compared to total assets actually fell. It was about 35% in 2023 and dropped to under 29% in 2024. Less reliance on debt means less financial risk. Simple as that.
That leads us nicely into their ability to actually pay those debts, liquidity and solvency. How do they look there?
Extremely strong. I mean, really robust.
Yeah.
For liquidity, the short-term picture, their current ratio is steady around 4.4.
Demi.
Meaning for every dollar they owe in the near term, they have about $4.40 in easily accessible assets to cover it. Very comfortable.
Okay.
But even better is the acid test ratio. That's over 1.7.
Right. Remind us what the acid test tells us again. More stringent than the current ratio.
Exactly. It's like the ultimate stress test for liquidity because it excludes inventory. What if they couldn't sell their current stock?
Ah, okay.
The fact that this ratio is so high, 1.75, means they could pay off all their short-term debts multiple times over, even if they didn't sell another chip they currently have. It's very, very liquid.
And long-term solvency.
Same story. Leverage is going down. The debt-to-asset ratio dropped to 0.29. Debt-to-equity fell to 0.41. It just confirms that shareholder equity is growing way faster than debt. They're funding themselves.
Okay, so bottom line. No worries about them going bust or not being able to pay their debts anytime soon.
Zero worries on that front right now. Extremely sound financially in that regard.
Let's shift to profitability then. Because here, things get a bit more nuanced, especially with the gross profit margin.
Yes, the GPM. We saw a slight but kind of continuous decline across the period we looked at. It went from nearly 79% back in 2021 down to about 75% in 2024.
Still incredibly high, but declining. What does that suggest?
It likely suggests a couple things. Either increasing competition is forcing them to price a bit lower, maybe in older segments like gaming cards,
Right.
or the cost of actually making these incredibly complex new AI chips is going up, probably a mix of both.
But somehow, despite that dip in GPM, their operating profit margin stayed really stable, around 63 to 65%.
Exactly, which is fascinating. The GPM dip happens before you account for operating expenses like R&D, sales, admin. The fact the operating margin held firm tells you they have incredible cost control below that gross profit line.
So they're managing their overheads extremely efficiently.
Masterfully, yes.
Okay, that brings us to what I think is maybe the most critical point we've uncovered. Return on assets, the ROA. It took quite a dip in 2024, didn't it? Down from over 77% to 65%.
Yes. This is the one metric that flashes, maybe not red, but definitely yellow. Investors really need to watch this one.
Why is it dropping when everything else seems so strong?
It's a direct consequence of that massive asset growth we talked about earlier, that $45 billion jump in assets in just 1 year.
Ah, okay.
When a company expands its asset base that quickly, building factories, or in this case, mostly through that huge rise in inventory and accounts receivable, the denominator, the assets part of ROA, grows faster than the numerator, the net income, at least initially.
So the new assets haven't had time yet to generate the profits to keep the ratio up.
Exactly. It suggests a temporary dip in how efficiently they're using their capital, purely because of the sheer speed and scale of the expansion. They're investing way ahead of the immediate returns.
Does it mean they're overinvesting or buying the wrong assets?
Not necessarily wrong. It's more about the timing and scale. It's not a sign of systemic failure, but it does raise the key question. Can management generate enough profit growth in 2025, 2026 to get that ROA climbing again?
Because if they can't.
If they can't, then justifying that $5 trillion valuation based on future efficiency becomes much harder. It's all about capital utilization from here.
That's a really important point. Let's quickly touch on cash flow before we move on. The ultimate health indicator.
Oh, cash flow is just phenomenal, almost untouchable. Look at the operating cash flow relative to total liabilities. It was nearly 2.0 in 2024.
Meaning what in simple terms?
It means the cash they generated from operations in just 1 year was enough to pay off all their debts, short-term and long-term, almost twice over. It completely validates the low leverage we saw earlier. They are absolutely flush with cash from operations.
Right, so the balance sheet looks incredibly strong, maybe bulletproof, if they manage that ROA challenge going forward.
That's a good summary.
But we know in tech, financials are only part of the story.
Yeah.
What about their competitive advantage? What's the famous moat protecting these numbers?
Well, it's really two things working together. Genuinely superior hardware and a very sticky software ecosystem.
Let's start with the hardware. How much better are the new chips?
Okay, let's compare. The workhorse until recently was the H100. Great chip, 80 gigs of memory, around 2,000 TFLOPs of performance, maybe $30,000 a pop.
And the new Blackwell B200.
It's just a different beast entirely. We're talking 192 gigs of memory. It's potentially 15 times faster for AI inference, 3 times faster for training. It's so powerful, it often needs special cooling, custom setups. You can't just slot it into old servers.
That sounds like a huge leap. But you said the hardware isn't the whole moat.
Correct. The arguably stronger part of the moat is their proprietary software platform, CUD.
Right, the parallel computing platform.
Exactly. This is what almost all AI developers, researchers, universities have been using for, over a decade now? They've invested countless hours building expertise and code on CUDA.
So they're locked in.
Pretty much. For a competitor like AMD or Intel, it's not enough to just build a slightly faster chip. They also need to convince potentially millions of developers to ditch CUDA, learn a whole new system, and port all their existing work. That's a massive, massive hurdle. The CUDA moat is very real.
But competitors are definitely trying, aren't they? Who are the main ones to watch?
You've got the direct hardware guys. AMD is the most obvious challenger with their Radeon gaming GPUs and, more importantly, their Instinct MI series for AI.
Okay.
Intel is also in the game, pushing their Xeon CPUs paired with their Gaudi AI accelerators. They're trying to offer a different kind of package.
And is there competition from the cloud providers themselves?
Yes, absolutely. That's the indirect but potentially very significant competition. Companies like Amazon, Google, even Microsoft are all developing their own custom AI chips.
But just for their own data centers, right? They're not selling them.
Mostly for internal use, yes. But think about why that matters. These companies are Nvidia's biggest customers.
Ah, right.
If they can increasingly use their own custom silicon for some workloads, even if it's not quite as powerful as Nvidia's latest, it reduces their reliance on Nvidia and, crucially, it puts a cap on Nvidia's future pricing power.
So even if Nvidia has the best chip, the cloud giants might say, well, our own chip is good enough for this task and it's cheaper.
Precisely. It creates a ceiling on margins long term, even with technological leadership.
Okay, so bringing it all together. Strong financials, powerful moat, but real competition and that ROA, question mark.
Yeah.
Let's talk about the big caveat, valuation. That price to earnings ratio near 100.
Yeah, that PE ratio implies absolutely stratospheric expectations for future growth. It demands a near flawless execution.
Especially with that ROA dip we discussed.
Exactly. They have to convert that huge $500 billion order book into actual high-margin revenue consistently year after year, and they need to do it while facing those rising costs and the competitive pressures, including the cloud guys' own chips. Any slip-up, and that valuation looks vulnerable.
So let's translate this into some practical thoughts for different types of investors listening. What about the long-term believer in the AI revolution?
For the long-term investor, I think the fundamentals, the profitability, the low debt, the clear leadership in a booming sector are still very compelling. The advice might be to actually use any significant dips in the share price as buying opportunities.
Right.
And given their financial strength and cash flow, you could argue that eventually they'll have the capacity for bigger share buybacks or even start paying more significant dividends down the line.
Okay. What about someone playing it shorter term, looking for a quicker trade?
For short-term traders, I'd urge a lot more caution right now. The stock is clearly volatile, the price is objectively very high, and you just can't ignore that recent dip in return on assets.
Don't just chase the momentum.
Definitely not. Mindlessly chasing these levels feels pretty risky. Maybe wait for a clearer market correction or consolidation before jumping in for a short-term play.
And finally, the more conservative investor, someone who prioritizes stability, maybe dividends.
Nvidia probably isn't the core holding for that type of investor right now. They should maybe hold cautiously if they already own it, or perhaps look at diversifying into other stable tech giants like Microsoft or Apple.
Because Nvidia reinvests everything.
Pretty much. Their whole culture is about pouring money back into R&D and growth, not paying out big dividends. So you have to be comfortable with the volatility that comes with a high growth, potentially high risk leader like Nvidia. It's not a sleep well at night stock for everyone.
Okay, so let's wrap this up. Thinking about everything we've discussed, what's the single most important takeaway about this $5 trillion giant?
I think the core message is the financial structure itself is incredibly sound. There's no imminent danger regarding debt or solvency. They make huge profits, that's clear. But the critical metric to watch over the next year or two is that return on assets. As they continue this absolutely breakneck expansion of their asset base, the number one job for management and the key thing for investors to track is efficiency. Can they make every new billion invested generate the profit needed to stabilize and ideally increase that ROA?
That efficiency question really holds the key to sustaining this valuation.
Absolutely.
And that leaves us with a final thought for you, the listener, to chew on.
Yeah.
We've talked about Nvidia being bigger than most national economies. What does that actually mean for global market stability if this AI spending cycle even just briefly slows down? What happens if Nvidia sneezes?
Does the whole world market catch a cold? The ripples could be far-reaching, well beyond just the tech sector, something definitely worth considering.
Indeed. Okay, that brings us to the end of this analysis. Once again, we'd like to thank our sponsor, Stonefly.
Yes, thank you, Stonefly.
They're leaders in enterprise storage, backup and disaster recovery, AI storage, and cloud solutions. If you need that robust data protection, remember, Stonefly offers air-gapped and immutable storage crucial for making your data ransomware-proof. You can contact sales at stonefly.com to schedule a demo.
Thanks for joining us for this look inside NVIDIA.
We'll see you next time on vpod.ai.